Hi there, I'm Verified Champion Trader Kevin Davey, and today we're going to talk about thinking like a trader. So let's get started. If you haven't signed up for my free Algo strategy, now's the time to do so. Hit the QR code or enter the link you see at the bottom, or in the description, you'll find a link. Sign up, you'll get this free algo and lots of other great information. In today's video, I'm going to get you thinking like a trader. And one way to do that is by always looking to reduce risk. And I'm going to share some code with you and some ideas for reducing risk in a little bit. But first, let's answer a question. What's more important to you? A, making as much money as possible by trading, or B, risking the least amount of money possible, but obviously still trading. Just answer A or B, which one's more important to you. And I'll share you my answer, and I'll talk about what other people said. So when I started out, I was struggling. Most people are when they start out. And my answer would always be A. I was always looking for the profit. I wanted to make money, right? Who cares about risk? Just make money. But now, after doing this for 30 years and doing a lot of aging along the way, and maybe my risk appetite's changed, B makes a lot more sense to me. I'm looking for a good risk-adjusted return, not just a good return. But I don't want to live on the edge of having tons of risk all the time to get returns. When I ran this in a live webinar, most people tended to say B, although there were a lot of A's, and then a lot of people were just adding comments of, hey, no, it's really both. And that's the answer. It's risk-adjusted return. Because you need to risk money to make money. And you can't have one without the other. Anytime you think there's no risk, chances are that's not true. Maybe if you're the first person to find something, there are risk-free returns out there, but they tend to disappear pretty quick. Because don't forget, with algo trading, there's a ton of other people wanting to algo trade too. And everybody's looking for the same thing. Newer traders, they get into trouble because they focus on profit. Where experienced traders, if you're thinking like a trader, you're going to focus more on risk. What can you lose? How bad can things get? That's where you want to put your focus. And that's my advice to you, to think like a trader. Focus on the risk side of things. Okay? It doesn't say ignore the profit side, it just says focus on the risk side. Let's look at what risk looks like in the past year or so. Here's a mini NASDAQ. And this is through like early 2026, so it includes 2025. This is the mini NASDAQ contract, and you can see back in April 2025, it had a $50,000 day. That's a lot of movement in one day. And then it also had some $20,000 ones. Big moves. Okay, a lot of risk. Gold, same way. There's a $30,000 move. In January of 2026, it had a $70,000 move. So a lot of volatility, a lot of big moves. Silver is even worse. For years, silver didn't do a whole lot, but then January 2026, it actually had one day that was $220,000 move. Huge move. This probably wiped a lot of people out. It probably made other people a lot of money, but the point is a lot of risk. And for the people who made money, they would have had to go short after this parabolic uptrend. Not a lot of people willing to do that. So this took some guts to take on that kind of risk to get that kind of return. So my point is, we've had a lot of these crazy risk events lately. So how do you do it? How do you avoid risk? Well, one way is when volatility gets crazy, like some of those times I showed you. Just go on the sidelines. Now, you could say, okay, well, hey, there's a new war starting, therefore I'm going to just turn off all my strategies. Well, that's kind of like an after-the-fact thing. One way you can be proactive about this is actually put it in your code from the beginning. So I'm going to show you an example, but here's a strategy that I had where it went way up and then crashed back down in late January. So it had a great up and a great down. And I'm going to show you a way I reduced that risk through a volatility switch. And there's a bunch of different ways to do it. I'm not going to explain them all here, but you could play around with this code. This is TradeStation code, but take a screenshot, type it in, give it a try. This one is the one I want to really talk about. It says if the average true range over the last 14 bars is less than 1.5 times the average true range over the last 100 bars, then you can trade. Okay, this is the vol can trade variable. So it means when the volatility is high, you don't trade. Okay, and then what you can do, here's a couple other ones, by the way, that are more unique, but you can try any of these. What I do is I say, well, if this equation says I can trade, well, then I could buy and sell. But if it says it's false, I want to not enter new trades and I want to exit all my existing trades. So it's basically a volatility switch which will just turn everything off. Okay, it's a neat way to reduce risk. The goals here were, one, to save my sanity. You know, when the market gets crazy, just go to the sidelines. Save yourself for another day. The second thing I wanted to do was try to reduce the number of big losers. That, you know, I don't want to get rid of the winners, although I realize it probably will. I just want to avoid the big losses. And in the process, get a better overall risk-adjusted return. So you remember I showed you this equity curve. When I put that one switch with the average true range, I get this. So I get the up, but it did not get the down. Now, obviously, there's going to be times where this makes things worse. Depending on your switch, maybe you eliminate all of the up and the down. You know, you have to test these things. Here's some sample results with that strategy. I won't go into all the detail except to show you that these were different ones I tested. 0, when vol switch is 0, that means no volatility switch. So going from 0 to 1, which was the average true range test, I reduced the average big loss from $32,000 down to $13,000 without reducing the number of trades by a whole lot, and my risk-adjusted return, my profit divided by max drawdown, also went up a bunch. Now, some of these didn't work out as well. One actually made things worse. So, obviously, I'm going to tell you what I always tell people in all these videos. Test it for yourself. See how it works for you. Play around with it. Different markets, different strategies will have different best approaches, okay? So you got to watch out for that, because you can definitely over-optimize these things. One thing I don't recommend is taking existing strategies and putting this switch on, unless you say, this is just how I'm going to do it, whether it makes my results better or worse. Because otherwise what people do is they'll take whatever worked better. Oh, for this strategy, using a volatility switch worked, but for this strategy it made it worse. So I'm not going to use it on that one, but I will on this other one. That's just optimizing. And you're bound to be disappointed with that. So the lesson here is the best traders, the people who are thinking like traders, said, how can I still get good returns and at the same time limit the amount of risk I have? And one way of doing that is heading for the sidelines when things get too volatile. It's just an approach. You can try it. Maybe you'll say this is dumb, but something to think about. Leave a comment. Let me know what you think. What do you do to reduce your risk? A lot of people use position sizing as an example, but do you do anything within the strategy itself? Let me know. Maybe I'll test it. Hit the like button. Hit the subscribe. I'll keep making more videos. I'm Kevin Davey. Have a great day.